For decades, you were told this was the safest place to put your money. Dividend Aristocrats. 25 consecutive years of dividend increases, the gold standard. The boring, reliable, sleep well at night corner of the market that every financial advisor pointed to when someone said they could not stomach volatility. And in 2026, I need to tell you something uncomfortable about that entire category. The safety you think you are holding may have quietly become the exact opposite of what it used to be. Let me start with the number that should bother you more than it probably does. The average Dividend Aristocrat today yields somewhere around 3%. 3% was a genuinely attractive number in 2015. It was a defensible number in 2019. In 2026, against the backdrop of what is actually happening in the broader market, 3% is not a reward for patience. It is the cost of waiting while something else captures the entire opportunity in front of you. Here is what most income investors are not pricing into their thinking. Dividend Aristocrat status is not actually a measure of business quality. It is a measure of consistency. A company earns that title by raising its dividend every single year for at least 25 consecutive years, regardless of what is happening in its actual industry. That consistency requirement creates a very specific kind of company, one that has institutionalized capital discipline around an unbroken streak, sometimes at the expense of aggressive reinvestment. Think about what that streak actually demands of a management team. Every single year, regardless of how the business is performing, the dividend has to go up, not flat, up. In 2026, with the pace of technological disruption moving faster than at any point in modern market history, that constraint is becoming a genuine competitive disadvantage. In 2026, with the pace of technological disruption moving faster than at any point in modern market history, that constraint is becoming a genuine competitive disadvantage. In multiple cases, we are seeing operational cost structures compressed by double digits within a single fiscal year, freeing up capital that gets reinvested directly into further scaling, further market share capture, further compounding advantage over slower-moving competitors. A company sitting on a 3% dividend yield while its growth stage competitor reinvests every available dollar into AI-driven scaling is not necessarily being prudent. It may be seeding the next decade. Look at what market share capture actually looks like in 2026 across sectors that used to be considered stable, defensible territory for legacy players. Industries that Dividend Aristocrats have dominated for generations are seeing meaningful share erosion to tech-driven challengers using AI as a genuine structural advantage. A legacy company defending its dividend streak is, in many cases, simultaneously losing the underlying competitive position that justified investor confidence in the first place. Here is the part that should genuinely concern anyone holding these names purely for income stability. A dividend streak does not protect you from competitive irrelevance. Here is the part that should genuinely concern anyone holding these names purely for income stability. A dividend streak does not protect you from competitive irrelevance. You can hold a stock with an unbroken 25-year dividend increase streak while the underlying business is steadily losing the market position that generated the cash flow funding that streak in the first place. The dividend keeps arriving right up until the moment the math behind it stops working. And by the time that becomes visible in the payout ratio, the competitive erosion has usually been happening for years. But the opportunity cost compounding in the background, the market share being lost to faster-moving competitors, the capital not being deployed into the AI infrastructure that is actually defining competitive advantage in 2026. That cost is real, even though it never shows up as a single dramatic headline. So what does a more honest 2026 framework actually look like? It does not mean abandoning income entirely or chasing pure speculative growth with no underlying discipline. It means recognizing that the binary most investors were taught, safe dividend stocks versus risky growth stocks, was always an oversimplification. And in 2026, it has become actively misleading. The more useful question is not whether a company pays a dividend. It is whether that company's capital allocation strategy is actually aligned with where competitive advantage is being built right now. A company aggressively and intelligently reinvesting into AI-driven scaling may be building far more durable long-term value than a Dividend Aristocrat protecting a streak. The companies actually winning this current environment share a specific profile. They treat capital allocation as a living decision tied to where real returns exist today. What they have in common is that the decision is being made based on current opportunity, not historical obligation. What they have in common is that the decision is being made based on current opportunity, not historical obligation. I am building out the specific framework for evaluating capital allocation quality versus dividend streak length. But first, I want to hear where you actually stand on this.